Hey, it's TaxQuips time from TaxMama.com. Today, TaxMama wants to talk to you about the unemployment refund checks the IRS has started to send out. Yours may be on the way. Well, my friends, in today's Tax Quip, I want to reach taxpayers who prepare your own tax returns. Please share this with anyone else who's affected. Let's do a little recap on the current situation. Long after millions of taxpayers filed their tax returns, the American Rescue Act in March of 2021, in that act, Congress decided to help out shocked taxpayers who learned that the unemployment benefits they received during this pandemic are taxable. Congress decreed that the first $10,200 of all unemployment benefits would not be taxable. So the IRS came along and said they would issue the refunds automatically and asked us all not to file amended returns until after they issued the refunds, as I reported earlier. Okay, now the refunds are arriving. Now that tax pros have seen how the IRS made their computations, they noted that many of their clients do need to file amended returns. Why? Well, frankly, for the IRS to perform a complete computation on each tax return would be so prohibitive that the refunds would be delayed for months, perhaps even years. Instead, they took a shortcut. They multiplied the amount of the unemployment exclusion up to $10,200, or double that for couples filing jointly in community property states, times the taxpayer's tax bracket. Now, this computation works really well for people who have jobs that provided health insurance coverage, little or no other income, and don't have children. For instance, let's look at a single person's income of about $42,000, including unemployment income. They would be in the 22% tax bracket. When you subtract the $10,200, their tax bracket drops to only 12%. So this person gets more than an extra $1,000 worth of refund. This person isn't going to want to amend. But what about people who have children or more complex returns? Well, dropping their income by $10,200 will reduce their adjusted gross income, or AGI for short, and might increase their refundable credits like child tax credit, earned income credit, and American Opportunity credits. The lower AGI may also increase their right to other deductions or tax credits, like suspended real estate losses up to $25,000 might become deductible. Non-deductible IRA contributions might now qualify for a deduction. Student loan interest and tuition fees are limited by AGI. They might become deductible. And the taxable advance premium tax credit, folks who got insurance from the marketplace, might well turn into refundable credits. Yes, I know that those people who ended up having to pay back some of that don't have to pay that back. Congress waived that for 2020. But by reducing the adjusted gross income, they might turn that forgiven debt into a tax credit, and this could be a substantial windfall worth thousands of dollars. Then let's look at people who have Social Security benefits. Normally, those benefits are tax-free. But when you combine Social Security benefits with other income like wages, self-employed business income, or investment income, or unemployment, then up to 85% of those Social Security benefits can become taxable. Dropping the adjusted gross income can bring the income low enough so that none of the Social Security benefits are taxable. For instance, let's say a couple is receiving $18,000 each of Social Security benefits, $2,000 of tax-free income, a pension of $20,000, and one of them got $10,200 in employment benefits, assuming they didn't get more benefits than that. Using live software, we determined that $11,270 of the Social Security benefits are taxable, and that ends up with them having to pay taxes to the IRS of $1,407. So they sent that money in with their tax return. But when we remove the unemployment from the equation, the taxable income is zero. The IRS, using their formula, would have sent them 10% of $10,200 or $1,020. By filing an amended return, they can get an additional refund of $387. And depending on the state they live in, they might get additional refunds from the state, although most states don't tax Social Security income in the first place. So good news for people with tax professionals. Tax professionals are going to be taking care of their clients either now or when you come in for next year's tax appointment. So feel free to wait until then and see what else the IRS does about issuing refunds to those people who paid the penalties because their income was too high for the premium tax credit. And more good news. The folks at VITA, Volunteer Income Tax Assistants, have told me that they will be reviewing the 2020 tax returns for their clients and that VITA does have the authority to prepare amendments for them at no charge. And that means that the teams at TCE, that's the Tax Counseling for the Elderly, which are often run by AARP, will probably do this as well. You might also be able to get help from the low-income tax clinics often run by colleges and universities if you have a problem getting the IRS to accept your amended returns. In short, although the numbers presented may not look enormous for some households, this can mean thousands of dollars worth of refunds for others. For some, it may only mean hundreds. It's well worth your time to recompute your revised tax liability once you get that IRS refund check. And remember, the IRS will be paying interest on the additional refunds, a lot more than your bank pays. And remember, you can find answers to all kinds of questions about taxes and business issues and EA education free. Where? Where else? At TaxMama.com.